Hello. In this video, we'll be going through bonds sold at a premium. Before we start, let's just go through how we determine the sale of a bond price. This has been covered in previous videos, so if you're not familiar with it and want me to go a little slower, you need to look at some previous videos from the chapter, specifically the bonds sold at a discount. We'll go through all this in a lot more detail, so I'm going to go through it rather quickly. But to determine the selling price of a bond is you have to take the present value of the principal amount of the bond plus the present value of any interest payments that are going to be made. The present values are going to be discounted or really using the market rate. And whereas the interest payments that are made, which is the cash paid from the bond holder, from the bond issuer to the bond holder, is going to be the face amount times the stated rate. Again, if you're not familiar with these terms or what I'm talking about, please go to a previous video. And as a refresher, bond prices are typically stated in terms of a percentage. So when you see a price quote of 98, it means a $1,000 bond is sold at 98% of its face value, which is $980, and a $1,000 bond sold for 101 means it's selling for 101% of its face value to give you $1,010. The bond selling price is determined based on the stated rate versus the market rate. If the stated rate, which is the rate that is actually stated on the actual bond, is equal to the market rate, then the bond is sold at its face value. So if I have a $1,000 bond with a 10% interest and the market rate is 10%, the bond is going to be sold for $1,000. If the stated rate is less than the market rate, then it will be sold at a discount. If the stated rate is greater than the market rate, then it's going to be sold at a premium. So premium is when the bond sells for more than the face amount. So if I have a $1,000 bond, if it is sold at a premium, it could be sold for $1,050 or anything more than $1,000. A $1,000 bond sold at a discount will be sold for less than any amount less than $1,000. Let's do a quick visual of what this means. So the stated, let's take an example where I have a stated rate is 10% and the market rate is 8%. So the market rate is you can buy or sell bonds out in the open market, and that's what determines what rate it's going for. The stated rate is determined by the bond issuer, and they can pick any stated rate. The stated rate is the amount of interest payments that bond issuer will pay to the bond holder. So let's just say I am Apple, the company, and I have bonds that I am selling out to the open market at a stated rate of 10%. Let's just say it's a $1,000 bond, which means that I'm going, and let's just say it's a 3-year bond, which is really short, but for this example, 3 years. So on 1/1x1, I'm going to sell a bond, and it's going to mature on 12/31x3. That's a really bad 3. Okay? And I will pay interest at the end of every year, 12/31x. At the end of every year, because my bond says its stated rate is 10%, I will pay my bond holder $100, 1,000 times $10 times 10% at the every year. And then at the end of the 3 years, I will also pay my bondholder the $1,000 face value. So this is the stated rate is 10%. If I, as a bond holder, were to go out to the open market, right, and the open market, the rate is only 8%, then if I were to buy this bond from any other company, they would pay me only $80 of interest at the end of each year, plus the $1,000 face value at the end of the term. So Apple right here, this is my top one, is Apple, is going to pay a stated rate that is higher than the market rate. Now, if they're going to pay, if I come to Apple and say, I want to buy your bond, and Apple says, well, okay, but we're paying you $100 a year of interest, but if you go on the open market, you get something less than that. So in order to buy our bonds, we want you not to pay us $1,000 for the bond. We want you to pay us something more than $1,000. Let's just say it's $1,060. So I, as the bond holder, right, the investor, will actually have to pay out of my pocket. This negative is my negative outflow from my cash. I, as the bond holder, will have to pay Apple more than the face value because I am going to get more interest every year than what is being paid out in the open market. Which is why when the stated rate is greater than the market rate, like in my example, 10% stated rate, 8% market rate, the bond is going to be sold for more than its face value, which is called a premium. That's what we're talking about here. So that's the same. Let's just go to an example, and this is the same example we've been using when we talked about bonds sold at a discount and when we talked about the effective interest method. If you have not seen those videos, please go back and watch them first. On January 1, 2027, MasterRay Industries issues $700,000 bond of 12% bonds dated January 1. So 12% is the stated rate. Interest of $42,000 is payable semi-annually on June 30th and December 31st. The interest payment is calculated by taking the face value of the bond, which we're told is $700,000, times the stated rate, times we have to multiply that by half because we get paid interest every 6 months, 6 out of the 12 months. So that equals to $42,000 will be the interest payment made. The bond matures in 3 years. The market rate for this bond is 10%. So in this situation, the stated rate is higher than the market rate. And United Intergroup purchased the entire bond issue, planning to hold the bonds until maturity. So how do we calculate the price of the bond? Well, there's 2 steps to calculating the price. Number 1 is we're going to take the present value of the interest payments. So we already know that the interest payments are $42,000 every 6 months, and it's a 3-year bond. So when we have to look at the present value of ordinary annuity because it's a series of payments made not made at the beginning of the term, but made it after the issuance occurred. So it's an ordinary annuity. A number of periods is 6. And this we use the market rate to determine our selling prices. When we look at the present value, we use the market rate, not the stated rate. Okay, the market rate is equal to 10%. However, that's an annual rate, and so we have to divide by 2 because we're making 2 payments a year. And what you're going to do is you're going to take that $42,000 interest payment times the present value of ordinary annuity using n equals 6 and I equal 5. So here I have pulled up the present value of an ordinary annuity table with n equals 6 right here. Oops. With the n equals 6 and then the I equal 5 right there. And then you can see that right here, the factor is 5.07569. So we're going to take the 42,000 times the 5.07569 equals 213,179. So that was the first step in calculating the price of the bond. The second step is we're going to take the principal, or also called the face value or face amount, of 700,000, and that is going to be using a present value of $1 because it's not a series of payments. Again, n equals 6, I equals 5, except this time we're going to be using the present value of a dollar table. Here, the present value of a dollar table, n equals 6, I equals 5 is highlighted, and that factor, which is kind of hard to see, maybe I should, is 0.74622. So here's my 700,000 times 0.7462 equals 522,354. When I add those two pieces up, I get 735,533. This will be the selling price of this bond that has a face value of $700,000. So whoever's going to buy this bond is going to be paying more than the face value, which means this bond is sold at a premium. That makes sense since the stated rate is higher than the market rate. So how will this be recorded? Well, Masterware is the issuer, the seller. They will receive $735,533 in cash. They're going to debit cash for that price. Our bonds payable amount is always going to be the face amount. That's for that account. So we're going to credit this liability of $700,000. And then we have a new contra liability account called Premium on Bonds Payable. And we're actually going to add it onto our bonds payable account. And it's the difference between the cash paid and the face value of the bond. So we're going to credit that for $35,533. The investor, the bond, the company that purchased the bond, now will have a debit investment in bonds for the face amount of $700,000. They had to pay out more than the $700,000, so they're going to credit cash for the $735,000, and then they're going to have a contra asset account called Premium on Bond Investment, and they're going to debit that account for $35,533. This is all covered in the chapter under investments, if you want to look at that further. So what I want to do is, again, if you haven't done so already, please go into the effective interest rate method video to see how the interest expense is recorded using the effective interest rate method. And in that video, we went through a very detailed example for bonds sold at a discount. I want to do the flip side here and go through the bonds sold at a premium, what the effective interest method calculation would look like. So up to here, we've seen, here's our journal entry for the cash for $735,000. We have a credit to bonds payable. Here's my T account for $700,000. And I have a credit to premium on bonds payable for $35,533. And if you look at the outstanding balance, I'm going to take my outstanding balance of this bond. I'm going to take my face value of $700,000, and I have a premium. I have a balance on my premium bonds payable for $35,000. So I'm going to add those two up, and my outstanding balance is $735,533 as my beginning outstanding balance. To determine the effective interest rate, to determine the interest expense using the effective interest method, we're going to go through that calculation here, but I want to point out that when you sell a bond at a discount or a premium, the interest expense is not the same as the interest payment. Remember in our example, the interest payment is $42,000 every 6 months. You'll see the interest expense is not $42,000. So when we look at the effective interest method, we're going to take, the way we calculate that is we take our beginning outstanding balance, multiply that by the effective rate or the market rate. Now notice here, our market rate in this example is 10%, but we have to divide by 2 because we make payments semi-annually. You can also take 10% times, we pay interest payments 6 out of every 12 months, same thing. And that gives us this number of 36,777. That's the effective interest, and I'm going to put expense because that's what we're going to record as an expense. Again, if this doesn't look familiar, please go into the effective interest method video for a very detailed explanation of all of this. So this is the amortization schedule for a bond sold at a premium price. Again, we have our dates. We're using for our initial date and every single payment, interest payment date. Our cash interest is going to be our stated rate, which is 12%, but we're going to divide that by half because we have 2 payments per year, times the face amount. So it's the 700K times 6%, and that's 42,000. That is the actual cash payment that we, as the bond issuer, will make to our investor. The effective interest, I'm going to put here, expense, is equal to your market rate. Okay, it's very important to keep these two rates straight as to where you use them. And again, this is divided by half because we have 2 payments a year, multiplied by your beginning outstanding balance, which is the same number as your prior period ending number. So I'm going to take my 5% times my 735,000 equals 36,777. When I take the difference between my cash payment, right, this is my cash payment, my interest payment of 42, minus my interest expense of 36,000, I get a reduction to my premium on bonds payable account for the difference of $5,223. And that difference gets subtracted from my outstanding balance, my prior period outstanding balance. Let's look at it through a T account because I do think this is easier to see. Here's my bonds payable T account, credit 700,000. Here's my premium on bonds payable that I initially credited 35,533. But here right now, I'm going to reduce that premium by this 5,223 for my first payment on June 30th. So my ending balance is 30,310. To get the outstanding balance as of June 30th, 2027, I'm going to take my face value, 700,000, and I'm going to add this premium, right, of 30,000. This ending balance right here is where that comes. So my outstanding balance is $730,310, which is the same number. My lines are not very straight, is right here. This up here, this upper half of the slide is just a different presentation. And again, you can go to the effective interest method video to walk through this if you want to understand it better. But it's just doing the exact same thing we did in the previous slide, just shown in a different format. But let's go through the journal entries that the issuer and the holder needs to record on the interest payment dates. So this is June 30th. The interest expense is going to be the effective rate, right, which was 5%, which is the market rate divided by 2, times the outstanding balance. So that's going to be this number right here. It's going to be this number, the 735,533. Which gives you 36,777. The cash payment for the interest payment is always the same, the stated rate times the face amount. So the credit to cash is 42,000. The debit to interest expense is the 36,777. And the difference is going to be a debit to the premium on bonds payable. And you can see that in this T account, that's what we're talking about right here. On the flip side, for the investor, the bond holder, they received $42,000 of cash, and they need to recognize interest revenue for the $36,777. And they calculate the exact same way. They take the effective rate, which is the market rate, times the outstanding balance at the beginning of the year. And then the difference is that they would credit premium on investment in bonds in their books. So we went through the initial issuance of the bond, the first interest payment. Let's just quickly go through the second interest payment. So again, the second interest payment remains to be $42,000. To calculate my interest expense, I'm going to take my effective interest rate, or also known as the market rate, and I'm going to divide by 2 in this situation because there's 2 payments a year, multiplied by my outstanding my beginning of the year outstanding balance, which is right here, the 730, and that gives me 36,516. That's going to be my interest expense for the period. I'm going to take the difference between my cash payment of 42 minus my interest expense of 36,000, and I'm going to reduce my premium on bonds discount on my bonds payable account by $5,484. Once again, here's the journal entries. Bonds payable 700,000. My premium on bonds payable started out with a credit balance of 35,000. On June 30th, I debited 5,200, and then on 12/31, I'm going to debit it for $5,484. So my ending premium on bonds payable at 12/31 of the first year is 24,000. And to figure out my outstanding balance, I'm going to take my bonds payable at the face amount, add in my ending balance of my premium bonds payable of 24,000. So my outstanding balance is 724,826, which is right here, my outstanding balance. To finish this off, this amortization schedule using bonds sold at a premium. Here is the full amortization schedule. This is the date of issuance. These are the first two payments that we went through, right? So here's my outstanding balance of 724,000 that we just ended with. So every 6 months, we're going to make a payment, and every 6 months, it's the same payment of 42,000, except the interest expense amount is going to be different every 6 months. You can see here, all these numbers are not the same, they're different. And that's because we're going to take our effective interest rate multiplied by our beginning outstanding balance, which is the same as the prior period ending balance. And that's going to give me my interest expense. And then the difference between my interest payment and my interest expense is going to be the decrease in the balance on the premium on the bonds payable. So at the end, after the 6 interest payments, I've debited my premium on bonds payable for a total of 35,533, and it would bring my balance in that account to 0. So the only thing that remains on my balance sheet is a bonds payable account for 700,000. So when I pay it out to my bond holder, right, I have to pay them the face value of the bond, and I'm going to credit cash 700,000, and I'm going to debit this account bonds payable of 700,000, and then I will have nothing left on my balance sheet.